Kia ora everyone, welcome back to our next edition of Econ Talks. Gareth, we've seen the latest GDP data out from Stats NZ for the first 3 months of 2025, showing a bit of a pickup and probably more than most people were expecting. GDP at a headline level up 0.8% for the first 3 months compared to a quarter before. That's on a seasonally adjusted basis. That's exactly what we at Infometrics were picking, ever so slightly stronger than market expectations, which was around a 0.7% increase, and stronger than where the Reserve Bank was, I think, originally pitching, which was more around 0.4%. So quite a bit more of a tune-up in economic momentum at the start of this year. That seemed to be fairly broad-based across the domestic economy.
Yeah, that was one of the nice parts of the result. It wasn't just one or two sort of areas where growth had picked up. It was quite broad-based, as you say. We saw more spending from households occurring, but more spending on durables coming through there, transport as well. And so that was a pickup after sort of a little bit of weakness in the latter part of last year, as what we saw with some of the consumer spending was being primarily driven by tourists. So there seemed to be a bit of a switch coming through in those numbers and a bit more coming through from your household spending as well. Also on the domestic front, more investment spending. And again, we'd seen like a little glimmer of that coming through in the previous quarter, stronger business confidence. That was reinforced in the latest numbers with business investment spending up by 0.6 from the previous quarter. And again, coming through in plant machinery and equipment in particular. And so more spending occurring in that category, just lending itself to that sort of business confidence and the, I guess, improved outlook that businesses were seeing there. And then when you get through into some of the other areas, but more production coming through as well, particularly in the manufacturing sector. And again, that was consistent with the investment activity that was going on around transport equipment as well. So yes, a fair number of positives coming through in the numbers. The other one that we saw was government consumption. That was up, maybe not so positive in terms of what our expectations were, because we know that government finances are tight and they're trying to sort of rein, or have been talking about reining in that spending, but not a lot of evidence, I'd have to say, of that over the last 6 months, both the December 2024 quarter and the March 25 quarter showing some pretty positive growth, and it was the sort of strongest 6-month period that we'd seen for government consumption spending since the middle of 2023. So not quite the sort of frugality that we had been expecting through there, contributing to that sort of increased demand across the domestic economy.
I mean, the tone in general seemed quite upbeat in some of those numbers. I mean, you look at the likes of that durable sort of increase. That's not tourists. They're not buying cars or clothing or similar. That's households who have got a little bit more interest in spending up a bit more. Again, sort of in line with some of that thinking around the fact that interest rates have come down. Inflation had been in a more moderate position through the start of this year. And again, I think sort of the tone for the first 3 months was of a bit more recovery before you had the likes of the Trump tariffs come through, before you saw some of the economic numbers stumble back a bit, before recent conflict in the Middle East as well. All of that has sort of shifted the tone. But sort of for the first instance, there were some not bad numbers coming through. Also, I think notable to see a bit more growth in our export numbers, particularly goods exports coming through, the likes of dairy and the likes. And I think when we're looking through the numbers, I remember thinking, geez, tourism doesn't look that great, a bit more of a fallback. But that was more because December was such a sort of bumper quarter that it sort of spiked up quite a lot, and then on a seasonally adjusted basis sort of came back down to more of a, I guess, normal position looking through all of those figures. Worrying, I think, a little bit below the surface in terms of how people are thinking about economic activity in terms of the short versus the long term. It was interesting, you mentioned the likes of plant machinery and equipment increasing in terms of investment. Does show that businesses are trying to do a little bit more technological advancement and similar. But one area we saw a fall, and this gets quite into the weeds, but it was sort of more intangible fixed assets. And when we talk to Stats NZ, that seemed to be more around the likes of ongoing R&D, which does suggest although we're doing some short-term tinkering around our business activity, business investment, we don't seem to be thinking quite as long-term at the moment, which goes to that, I think, very challenging time where businesses just aren't quite sure what's up or down. The other part as well, that you sort of got into it a bit in terms of the likes of transport manufacturing, but we did see a bit more on the production side in terms of higher levels of activity. The likes of manufacturing sort of stood out alongside a pretty big boost in the likes of professional services. That didn't seem quite as broad-based, but still some sort of comfortable numbers, I guess, coming through for the start of this year, but not everyone was doing quite so well.
No, when you look through those services areas, like you say, professional services, administrative services, and support services as well, those were up and they have had a rough few quarters, to be clear. So a bit of growth there is more than welcome. But I think most of the services sort of industries, when you look through them, they failed to grow. They were still contracting. And the ones that did grow, did grow apart from the professional ones were kind of government generated, sort of in the health and to a lesser extent education area as well. So there is still some caution in those services areas. Some of that related perhaps to the not quite so strong tourism numbers that were coming through, and we saw the weakness, for example, in arts and recreation down that end of the services spectrum as well. But generally not quite as broad based there, and so it does reflect that while growth has been improving, there is still, I guess, a degree of patchiness to it. And then when you start to look forward, of course, like you say, a lot of that growth, all the numbers coming before Liberation Day, coming before the increasing unrest and conflict in the Middle East as well. So just a new layer of uncertainty coming through there. And some of the partial economic indicators we've got for the June quarter so far have just suggested there's a bit more weakness coming through, whether it's household spending and electronic card spending, whether it's manufacturing activity, which had started the year, as we said, positively, but not quite so strong in the last month or two. Those figures just suggesting that, yeah, perhaps we shouldn't expect this positive result to be repeated in the June quarter. And given some of the other stuff that's happened over the last few days around the conflict in the Middle East, does suggest that the difficulties potentially stretch into the September quarter as well.
Indeed, and I thought it was interesting as well. I mean, you saw in a number of cases where there was a bit more activity. Also important, probably not to overblow how good that was. It might have been up on a quarter or so, but it's generally still down on a year. Even headline GDP up 0.8% quarter on quarter, but on an annual basis, you were looking at, I think, economic activity still sitting 1% or so below where it was 12 months ago. So we had seen a bit more of a rebound out of the hole, but we're still sort of in the hole a little bit more, and it is a bit tougher to get that momentum coming up. I think as well, I mean, you look at the result, was better than the Reserve Bank expected. That combined with a number of other inflationary pressures at the moment does seem to have most people expecting there's not quite as much of a chance of further interest rate cuts in July at least. The latest market pricing suggesting around a 20% chance of a further 25 basis point cut in the official cash rate come July, but more expectations for sort of a resumption at some point in the second half of 2025. Again, just that level of caution at the moment that no one wants to definitely go all in on what is quite a topsy-turvy time. You started with that better momentum. Things have definitely shifted back. It seems like people are going, look, there was a bit more at the start of this year, but now that uncertainty has crept back in so much more, people who had a bit more momentum are now sitting a bit more on their hands. They've sort of done their pre-purchasing. They're ready if there is a bit more of an upturn, but they're not getting anything further going because it's just not clear that it will sustainably be there. We'll continue to assess all of that, including what happens to interest rates and what happens to economic activity on one of our future editions of Econ Talks.